What is the role of finance in the firm? Well, to answer that question, we first need to ask ourselves, what is a firm? What is a company? What is a business? We can think of a firm as a nexus or coming together of different policies. These policies include management, how are resources controlled and deployed, operations, how are resources used on a day-to-day basis, marketing, how are resources converted to income, accounting, how to measure and report performance, information systems, how to share information within and outside of the firm, and the focus of this course, financial policies. So what is finance? Simply put, finance is the art and science of managing money, and this involves making decisions. The decisions may be short-term, like determine the right amount of cash to hold. The financial manager is also involved with other working capital decisions, such as accounts receivable, whether and how much credit to extend, inventory levels, and accounts payables. The financial manager doesn't make these decisions unilaterally, but instead works with management, operations, marketing, accounting, and information system folks to help determine firm policy. The firm manager is also involved in making longer-term decisions on capital investments, how to finance those investments, and how to share the proceeds from those investments with the firm's owners or shareholders. So now that we know what a firm is, we ask ourselves, why? Why does the firm exist? It exists to create value for stakeholders. And who are these stakeholders? Well, they include employees who rely on the firm for wages and benefits, vendors whose success depends on the firm doing well, the local and larger communities via taxes and corporate involvement, and investors. Let's examine the firm and the issues it faces with a hypothetical startup. Suppose you've always dreamed of starting your own business. You identify a product or service that you believe has potential and decide to start a new business. You may decide to start your new business as a sole proprietor. Sole proprietorships are easy to set up because there's not very many paper or legal requirements. An advantage of a sole proprietor is that the owner pays all taxes at the individual level, right there on Schedule C on the owner's IRS 1040 form. For these reasons, the sole proprietorships are the most popular type of firm organization in the United States. They tend to be small, though, and while they account for over 60% of all firms, they only account for about 2% of all business revenues. The major disadvantage of the sole proprietor is that owners are legally liable for debts and other claims, including legal actions such as lawsuits, on the business. But suppose you find a partner who shares your vision and has some of the skills and financial resources the startup needs. Then you organize the new firm as a partnerships. Partnerships are very similar to sole proprietorships, but they tend to be larger. You and your partner realize the goal of this new business is to make both of you wealthy. Therefore, the goal of the firm is wealth maximization. Wealth maximization requires profits, at least eventually, but there's a difference between maximizing wealth and maximizing profits. Consider this example. Suppose a firm has two investment opportunities, a rudder investment opportunity and a propeller, with the annual earnings per share listed here. And the propeller investment we can see here, it generates more earnings per share or profits over 3 years, 325, than does the rudder proposal of 315. Now, profit maximization, if we looked at that, we'd say, well, the propeller is the better investment. That's not always right, because first, timing is important. All else being equal, we'd rather have flows occurring sooner rather than later. And there's also the risk. What if, for example, the propeller project is much riskier than the rudder project? Would that change our decision on which project to invest in? And third, profits do not necessarily result in cash flows available to stockholders. There's a difference in accounting values and cash flows. Consider a boat dealer who sells a new boat for $100,000 but hasn't yet collected the money. The boat cost the dealer $80,000 and the dealer has already paid the manufacturer, but hasn't been paid for the boat yet. The accounting method uses accruals to compute a net income of $20,000, $100,000 for the sale, $80,000 the cost of the boat, $20,000 profit. But the money hasn't been collected yet. In contrast, the financial manager uses a cash basis to compute a negative cash flow of a negative $80,000. I haven't received any payment yet, had to pay for the boat, therefore a negative. Now, whether we use accounting, profit maximization, or wealth maximization, cash flows, is going to affect our decision making. For example, if we look at cash flows, we may say we want to get paid no matter what. Or if we look at profit maximization, we may say, let's just look at sales. Let's get back to our startup firm. Short and long-term financial decisions impact shareholder wealth. In the short term, decisions about cash and working capital affect the solvency and efficiency of the firm. In the longer term, decisions about what investment to make, so startup, right, company, right, so investment capital is tight, how to finance those investments, whether it's going to be owner's equity, or they get money from a private equity fund, a bank loan, and so on, and how to reward investors for taking the risk of providing financing affect the value of the firm. So both short and long-term financial decisions affect the value of the firm. In the early years of your business, you minimize unnecessary investments. This means little or no office furniture. And your office and factory may even be in your garage. You also don't want to draw a paycheck in order to preserve cash for investment. You may even have to rely on your spouse or significant other to survive. It looks like your business is going to succeed. The firm is growing in sales, assets, and employees, and you decide it's time to consider another form of business organization. You decide to organize your business as a corporation. Incorporation offers many advantages to a growing firm, but the most important are limited liability. Owners can only lose the value of their investment, and the ease of ownership transfer. You can sell fractional shares of ownership in the business. But there are some disadvantages. The business must file articles of incorporation with the state. These articles require a board of directors, regular meetings, and official appointment of a president or CEO. However, the most important disadvantage of incorporating is the profits are taxed at the corporation level, and owners also pay taxes on dividends. That is, profits are taxed twice, at the firm and again at the owner's level. The decision to incorporate introduces the possibility of a separation of ownership and control. That is, the owners of the firm may not control the firm. However, because your corporation is closely held, you control the board of directors and elect yourself CEO. This keeps problems from separation of ownership and control from becoming too large. However, as your firm grows, you have many managers, including financial managers. So what should be their guiding principle? You can't micromanage them all day long. Incorporation hasn't changed the goal of the business, that is, to generate wealth for the owners. However, now that the business is incorporated, owners are also called shareholders. The goal of the firm's manager, and especially the financial managers, is to maximize shareholder wealth, that is, to maximize share prices. This means managers must determine how every decision or action will impact the firm's return and risk. So, for example, if a decision increases returns and either doesn't increase risk or even reduces risk, share price is going to increase and we should accept that decision. On the other hand, if returns don't increase and risk remains the same and decreases, share price will likely fall and managers should reject the decision. Let's fast forward a couple of years. Your startup continues to grow and you're becoming quite famous. Your firm becomes so successful that investors are clamoring to buy shares in your company. You enlist the services of an investment banker to take your company public. In the process, you sell many of your own shares and make a lot of money. You have struck it rich and life is good. But you realize that you now own the firm with thousands of other investors. Suppose you sold 75% of the company during the IPO, initial public offering. This means you're only going to get 25% of the wealth generated by the firm. It also means that you pay only 25% of the cost of the perks the firm grants you. All of a sudden, you have incentives to work less and consume more perks, like sports cars and yachts. This leads to a problem. You, the driving force behind the firm, are not creating for the value for shareholders as you once did, and the firm begins to suffer. The other investors fire you. You have allowed the principal agent problem to destroy shareholder value. Your excessive consumption of perquisites and reduced effort are agency costs that are borne by the shareholders. The principal-agent relationship is an arrangement in which the agent acts on behalf of the principal. For example, shareholders of a company, the principals, elect management agents to act on their behalf. Agency problems arise when managers place personal goals ahead of the goals of the shareholders. Agency costs arise from the agency problems that are borne by shareholders and represent a loss of shareholder wealth. But there's a happy ending. The managers the board of directors appointed to replace you don't do a very good job. You still have a large ownership stake in the company and as a result still have a seat on the board. You convince your fellow directors to appoint you as the new CEO of the firm you founded all those years ago. Those darn agency problems.